All right, boys and girls, we're going to start in 3 minutes. Chris Capre, former hedge fund trader, A lot of you guys know him already from the Benzinga Option School. He's the chief educator there. So that's what he does all day, full time, like morning classes, all that stuff. So yeah, guys, we're going to be starting here in a couple minutes. So just make sure you're ready here for the session once we start. Any questions, put them in the chat too. All right. All right, people, we're going to start. Okay. We're going to get this going now, guys. So I see a lot of you folks are already here in the chat. Andy, Bill, Brandon, Bree, Chris, Sinette, Derek, Everett, Jackson. What's up, dude? Gary in the house, George, Jane, Jeff, Jorge, Justin, Nancy also in the house. I see you. Okay. RH, Reza. What's up? A lot of friendly, familiar faces. Cool stuff. We got a nice group of people here today. I like it. So just want to recap what we're going to do here today. We're going to be with Chris Capre, chief educator at the Benzinga Option School. We're going to be going over some really good information. He's got something really special planned for you guys. In the chat, let me know when you're ready to start. What's up, Reza? Brandon, what's up? Let me know in the chat when you're ready to start and also where you are tuning in from. All right. We want to get a feeling for the base of Benzinga. We know it's worldwide, but we get some interesting places here and there. So by the way, I forgot to introduce myself. I'm Rodrigo. Nice to meet you guys. I think I've seen you before. All right. Ruby in the house. Jeff is in Chicago. UK, what's up? All right, guys. So let's go ahead and bring in here Mr. Chris Capre, former hedge fund trader, 20 years of experience in the game. A lot of you already know him from the Benzinga Option School. Very familiar face. So he's going to be here with us today. He's got a session planned out. Chris, let me know when you're good to go. When you have your
good to go.
Good stuff. The time has come, folks. School is in session.
Oh, we just lost your volume for a second here, so I missed that last part of what you were saying there.
It's that school is in session. We are officially in session.
Time for the opening bell.
Let's do it.
All right, let's do some video here for a second. And you should be seeing me. All right. So you got my video there, Rodrigo?
Folks in the chat, I think so. I don't know what I'm looking at. I don't see anything being shared right now.
No video. It says stop video. Oh, I think you have to give me control of the presentation. So let me take over here. There we go. There we go. Very nice. Okay. Put a 10 in the chat if you guys can see me. We have video and the presentation. And put a 5 in the chat if you can see this chart on Peloton. Very nice. I appreciate it. Good to see everybody today. Okay. All right, Rodrigo, let's roll with it. So today's video, today's lesson on YouTube is we're going to be talking about strategies and setups for the week ahead. Just grab my juice over here. So tricky week. And we got kind of a lot of what I would call kind of conflicting signals in the markets. In some sense, we have some positioning in the market that is currently bearish when we look at the options market and the options positioning. And at the same time, we have some positioning that would suggest that maybe the market is close to coming a bottom and there's some bullishness there. So we're going to kind of unpack all that today, kind of give an overview of what's going on in the market. And then we're going to be talking about potential trade ideas or how I'm looking to trade this week, which is, a somewhat tricky week to trade with all these kind of signals. Some are bullish, some are bearish. How do we trade these situations? It's much easier when the market is all bullish or all bearish. That's much easier. But the real thing is what happens when the signals are mixed and how do you relate to that? How do you find ways to extract alpha from the market? So we're going to be talking about that. Before I do want to I'm not going to say toot my own horn, but we did say ahead of time here that Peloton, we had talked about Peloton last Tuesday live on this Benzinga channel. And we had said, we think that Peloton has hit its high for the week and that it was going to pull back to 35, maybe and lower. And we also gave this shout out to our members ahead of time. This was on 9:21 a.m. on the last Tuesday. And so I'm just going to real briefly recap for those of you that were not there about the Peloton trade and what that all meant and everything like that. Before we do get into all of this, though, there may be some of you in here that have never seen me before. If you have never seen me present live before, put a 3 in the chat. So if this is your first time watching a webinar from me or any presentation from me, put a 3 in the chat real quick. Okay, Bill is, okay, cool. RH, copy that. And also into my Zoom, my YouTube people as well. Put a 3 in the chat if you get this. I know there's a little bit of delay between Zoom and YouTube Live. Okay, a fair amount actually. Hold on, I'm going to go off camera here for a second. Okay, I had something in my teeth there I had to get rid of. All right. Okay, so a fair amount of people that never seen me present before. Okay, so real briefly, before we get into the presentation today, before I talk about Peloton, SPYs, IWMs, what I'm thinking is going on in the market and how to trade this week, just a real brief bio on me. So I am over a 20-year professional trader. I was a former broker on Wall Street. That means I worked on Wall Street. That means I walked Wall Street to work every single day. I was there every single morning, walking between 7:30 and 8 a.m. towards my work for the market open at 9:30. So I did that. Worked on Wall Street in between 04 and 06. And then after that, I got a job trading for a hedge fund from 06 to 07. And after that, in 07, I went private to open my own company, Second Skies Trading, where I would kind of teach my own kind of methods and strategies to trade the market and trade, basically in the format that I want to trade. And so I have institutional trading experience. I've been trading for over 21 years. I've traded through the .com bubble. I've traded through the flash crash. I've traded through the London terrorist bombings, which was in July, I believe, of that year. I've traded through it all. And I've seen literally a market crash or correction of 20% or greater pretty much every year, every other year for the last 20 years. So every 2 years, I've seen some sort of crash of or type of markets or out and outright straight up like full on bear market where the market is correcting 20, 30, 40, 50% or more. So the .com, one of the biggest bubbles in history, the great financial crisis of 07, 08, one of the biggest financial bubbles in history. I've traded through that. I've traded through the COVID crisis. And so I have just a lot of experience that in the markets, experience matters. I learned very on when the London terrorist bombing happened. I was working on the desk at that time when it happened. And there were a lot of people around me that were of different levels of experience, and we all traded it differently. And the most senior traders and the most senior brokers were the ones who made the most amount of money because they had the most amount of experience on how to trade that market. And it really taught me the value of experience. While I made a lot of money on that day, there were other people who made a lot more money than me by like 4 times the amount. And what was the difference? It wasn't technical skill. It had nothing to do with that. It wasn't that one person was able to press buttons faster than I was. It was simply the fact that they had more experience on how to handle that situation than I did. And so trading is one of those environments where experience matters. And so, up to this point, I've probably spent well over 50,000 hours behind the charts. And that is kind of what I'm sharing with you today. And so I am the head of the Benzinga Option School. We recently created this in the last couple months, and we are now teaching members how to trade options. And we start them off on the most very beginner level and work their way up to where they're teaching them advanced concepts and options and methodologies, like how to understand dealer hedging activities, how to trade off dealer hedging activities, how to understand what the market is going to be more or less volatile on a day, just because we understand the overall positioning in the market. And so that is kind of the things we teach. We go through everything from the most easiest stuff to what is a call and a put, all the way up to some of the most advanced stuff, which is the various levels of dealer hedging activity and how that's going to influence the flows for the day. So this is what we talk about in the Benzinga Option School. And I'm going to talk about little pieces, a little snippet here and a little snippet there and a little piece there of what we do in the Benzinga Option School. And I'm going to translate that into potential strategies and how we might trade for this week. So that is what we're going to focus on today. I know somebody had asked a question earlier for my members in the Zoom audience here. I have Zoom and YouTube live, and shout out to my YouTube members that are seeing me for the first time. So for Zoom members, you have a chance to post your questions. When you do, please post in the chat, because if you post in the chat, then I only have to look in that box. If you post it in the Q&A, then I have to have more boxes open, and I already got 4 screens and 3 different apps and a platform and this and everything. So if you can, post all your questions in the chat. Okay, so before we move on to strategies we are going to talk about for this week and how to trade this week, I just want to briefly talk about a trade that we had talked about last week on Peloton. That was a trade we made live, and we had talked about this with our members and shared our analysis live of what's going on in the market. So as many of you know, last week, Peloton had a very interesting day on Tuesday, where after earnings, which came out negative, Peloton actually had a move from pre-market lows of 25, and it shot up to about $40 on the day. And it was one of the probably most active trading days in Peloton's history. And we were actually able to pretty much call the top within a matter of minutes. Like within a matter of minutes, we were able to call the top, while everybody else on social media was saying, buy, it's going to 45, it's going to 50 and everything like that. We used our option skills that we teach in the Benzinga Option School. We use those skills to call the top in the day and come up with a trade idea to actually sell Peloton when it was screaming upwards. And we're going to talk about how we did that. So we posted a note in the Benzinga Option School, and this is what it reads. We said, Peloton has exploded in share size today. At the time in this writing, 9/21, Peloton had already done 150 million shares on the day. It ended up at about 245 million. Extraordinary amount of shares. And we said IV, which is implied volatility, which is one of the metrics that determines the pricing of options, implied volatility. We said implied volatility has spiked to over 250%. This is an incredibly high number for a stock like Peloton. My first comment is, I don't think this is sustainable, especially since there are lots of short-dated options. Short-dated options are expiring, options that are expiring at the nearest expiry, which is in this case, it was that Friday. Over 200 of the 720,000 options on that day up to that point were short-dated, meaning theta will start to kick in heavily on Wednesday, Thursday, and Friday. I suspect that unless Peloton finds a buyer this week, based upon the potential rumors that were coming out, unless they find a buyer, the stock will pull back due to massive time and implied volatility decay. In other words, implied volatility is going to come down because it's overly priced. And as time passes on, these short-dated options are going to start to lose value. That's called theta decay. I said there are lots of short-dated calls at the 40 strike, but very little beyond that. So at that point in time, option traders were buying lots of calls all the way up to the 40 strike, but they weren't buying anything after that. So that was kind of like that was like one piece of the puzzle was saying, I'm not sure it's going to make it beyond 40. This means Peloton might struggle to get beyond 40 for the day. And if nobody buys calls further above this strike for this expiry or the next expiry, then we have our short-term resistance for the week. So I'm looking to short here as soon as I see enough weakness. We're going to do so with fixed risk options. Fixed risk means that there's only a set amount of loss we can take, so that if it does keep screaming higher, it's not a big deal. We have like capped our losses at a very specific amount. And we're doing this in case it explodes higher. But it's unlikely we get another day like this with 150 share volume on the day. And then I said, one last thing. The 1-minute charts show a volume spike on the move into the highs on that day. That was around 39.16. However, it tries another push up and it has weaker volume. So now we're getting more and more signs that this Peloton move from 25 up to 39 at that point is running out of steam. That combined with the options led me to believe that this Peloton move was done for the day and I should start looking to short, which is pretty brazen considering the fact that the stock is having one of its biggest single day rips in history. And I'm sitting there going, yeah, I'm going to short you. In the face of all this, in the face of hundreds of millions of shares being traded, I'm going to short you because I think we hit the top. All my options information and all my price action information has suggested that we have hit the top for the day. This is posted at 9:21 Pacific at that time. Now, this vertical line represents 9:21 Pacific. And what did we say? We think 40 is going to be our resistance for the week. Here's the first volume spike into the highs. Here's the second volume spike into the same highs, which is lower. And what happens? It goes right up to 40. We actually have no candle, not 1 minute candle close above 40. And in one candle, we go from 39.79 to 40.36, and then it sells off. Now, what happened with Peloton since then? Sold off rest of the day. And I told my members, hey, I think this is going to $35 or lower by the end of the week. And what happens? It goes sideways for a couple of days. I'll switch this to the 5-minute charts. Goes sideways. And lo and behold, look at where it closed on the 11th, which was Friday, below $35. Rodrigo took that trade. Many of my members took that trade, both in the Benzinga Option School and Second Skies. In the face of one of the biggest kind of screaming days to the upside, we sold it in the face of all that, timed it perfectly. We're like literally 20 minutes from the top and made our money on the day. By the end of the week, hit our targets, done. How did we do that? It was really a combination of two things. Price action skills, but the primary driver of the trade idea was my option skills. The same option skills I teach in the Benzinga option skill and course. So I use my option skills to identify a trade that had kind of gotten dislocated from reality and had an unsustainable course that it was on. And that meant that all else being equal, most likely Peloton was not going to make any new highs on the day. And it didn't for the rest of the week. This candle was the high for the week. It never got back up there again. You did have a couple other opportunities to short it in the aftermarket here and on this day, but you wouldn't have ever gotten a better price than pretty much what we called it. So these types of skills are the skills that you can learn that can help you avoid getting into bad trades, which would have been buying Peloton at $39 or buying Peloton at $40, and help you make good trades, selling at $39 or $40, holding it for a few days, and hitting your target by the end of the week. And so my job as a trader, particularly with the Benzinga Options School, is to teach our members various skills that the option market presents that will allow you to see price action and allow you to see trade opportunities that you will not see if you are just looking at the price action. If you're just looking at the price action, you wouldn't have known that there was a lot of options being traded on the day. If you didn't have the option skills, you wouldn't know that the implied volatility wasn't sustainable. If you hadn't looked at the open interest for that day, particularly the short dated interest, you wouldn't have known that the stock was unlikely to make a serious push beyond 40. You would have just been looking at the charts and reacting and missing this other element of data that is a major aspect of order flow in the markets. In some cases, one of the largest aspects in the markets. Option flows right now are some of the most important flows of the markets. In other words, they're some of the most important drivers of the price action in the markets. And if you don't understand them and what they mean, then you are missing one of the most dominant drivers in the markets. And with the S&P 500 not being really that much traded in terms of share size, liquidity is low right now in the S&P 500. And yet the options market is strong. So if you really want to make money on a daily basis, and if you really want to see what's going on in the market and be able to kind of forecast directions with a higher degree of accuracy and skill, you have to be incorporating options into your skill set. If you're not, you are missing one of the most important pieces or drivers of the price action in the market today. So with that being said, I'll take a few questions and then let's go ahead and move on. Okay, nothing in the YouTube chat. So let's take a look at K Smith. K Smith has a question. Where do you look to see the volume of shares traded on the day? TradingView has it in here. It will show you right here volume. That's the volume on the day. And then it also gives you a nice comparison. This is actually really nice, which is a 10-day volume average. So what is the average number of shares over the last 10 days? This is helpful because it can tell us, are we above the 10-day average or are we below the 10-day average? If we're above the 10-day average, then that means there's a lot of different eyes on the market, institutional, retail, everybody. If there's a lot of shares being traded well above the 10-day average, then the market, there's a lot of traders looking at it. That creates a lot of opportunities for flow pushing in one direction or the other, or potential reversal opportunities when that flow steps out of the market. And that's what we were suspecting. We were suspecting, hey, we're at 150 million shares on the day at that time. This is exceptional compared to the 10-day average, which is only about 40 million shares up to that day. It ended up at 245 million shares on the day. It's absolutely huge. That creates situations where if you have a massive run up on a high share volume day, unless you have more new people coming in to buy it, you're not going to have as much volume to hold up the stock. There's a chance that the stock starts falling back, and that creates a potential trade opportunity. So hopefully that answers your question on that. Brandon Davis has a question. So would you have wanted to get long a put? Not necessarily. So a put, if you get long a put, that is a bearish play, which makes money if the stock goes down. But how also does a put make or lose money? Who knows the answer? So what other variables affect the pricing or profitability of that put? Who knows the answers to that? Put your answers in the chat. Yes, Mr. Goodman says volatility and theta decay. Okay, great. So in this case, if I get long a put, and the way we write this in the Benzinga Option School is if you get long a put, let's go back to the day. Let's go back to the day. Ugh, I did not mean to do that. There we go. I hit the whiteboard feature on my thing. All right, so let's go back to the actual day. And here it is. And we think this is the top on the day, okay? So here we are, right around here, and we think this is the top on the day. Okay, the way we write this in the Benzinga Option School is if we want to get long a put, we put a plus P. If we want to sell the put, we put a minus P. So in this case, let's say we want to get long a put. Okay, well, if I get long a put, that means I'm also long two other things that go with it. So I'm not just bearish on the direction, but I'm also long volatility, and I'm also long theta, time decay. So what this means is that if I am buying this put, I also need implied volatility to stay where it is or go higher. If implied volatility comes down, then I'm going to actually lose money on this put. Even though the put's going in my favor, if implied volatility goes down, I'll make the money on the deltas from buying the put, but I'm going to lose money on the implied volatility coming down because implied volatility is a variable that affects the pricing of options. And so the problem with getting long puts at this point is implied volatility, which I mentioned in my commentary, is already high. So if this is like a volatility, so to say, spectrum, and this is low volatility, and this is medium volatility, and this is high volatility, and this is one of the highest levels of implied volatility I've ever seen, well, then the risk on volatility is that it comes down. So I could get long puts and make money on direction, but if implied volatility comes down, that's going to decrease the value of my puts. I will lose money on implied volatility. So getting long puts is actually not a good idea in that situation because implied volatility will come down and that will lower the cost of my option and take money away. In other words, I'll make money on the deltas, but I'm going to lose money in implied volatility. So that's not the best strategy for that. So yes, that's a good question. Also, as Mr. Goodman pointed out, Mr. Goodman is one of my longtime Second Sky students, is that when you're long puts, you are also exposed to time decay. Now, I didn't know exactly when that Peloton would reverse back to 35. I just felt like, hey, if there's a lot of options expiring this Friday, and a lot of those options are calls, as the market gets closer to Friday, those calls are going to get monetized because they're eating theta decay every single day. So to avoid eating theta decay, I do not want to get long puts, because if I'm long puts, every single day that passes, I'm losing value on that option due to theta decay. So long puts was not the trade to take on that one. Does that make sense, Mr. Davis? Brandon, does that make sense? Put a 1 in the chat if that makes sense. Jeff Anderson says yes. Chris Knight says yes. George Williams says yes. Mr. Brandon Davis, does that make sense? He said Zoom is really choppy. I'm sorry about that. He's back on YouTube. I was looking for him here. Hold on one second. I just got something. I got a mint leaf in my throat. Okay.
Hey, really quick, Chris. I'm getting a lot of emails and questions about the school, so I'm just gonna, go over a couple questions here, and then we can get back on here. So yes, just gonna answer some of the emails that I got here. Yes, there's a 7-day money back guarantee on it, so you can try it out. So it is open. Enrollment is open. If you guys do want to join the Benzinga Option School, you get Benzinga Pro with it as well. All of the lessons that Chris does every day are recorded and they are saved in the video library. So even if you have, a 9 to 5 or you're busy, you can always go back and watch them. So they're always going to be there. There's chat rooms there. You'll have the chat room for Chris Capre where he put that Peloton trade that you could have profited off as well. So, and maybe you can show them the library there. So some of the lessons, I know it's a lot of material. So yeah, I think that's most of the part for the questions, but I'll post a link in the chat, and
okay.
Any questions, just reach out, guys.
Okay. So let me real quick, before we get into the Benzinga Option School, let me just kind of wrap up this package of the Peloton trade. We're getting a lot of questions on that. So I'd like to wrap this up, and then we'll take a quick look at the Benzinga Option School. Okay. So Mr. Brandon Davis says, yes, I come to the YouTube channel. Okay. Copy that. All right. So a few other questions. Andy Story says, what actual trade did you do? Sell call spreads, buy puts? No, we didn't buy puts. And we don't want to sell call spreads because of the fact that if it's kind of one of those situations where the stock could keep exploding higher. And while I could hold that trade through expiry and neutralize the volatility aspect of it, it might shoot up incredibly high the next day. And so if I was to sell a call spread, which would be, so I'd be selling, let's say I'm selling the 40 calls, so minus 40C, and then I buy calls further up, I'd have to hold this to expiry to cap off my risk on that. But the thing about it is that's not the best trade. That's still not the best trade. I am taking advantage of this here, but the call that I'm buying further up isn't going to capture the full profitability of this. So, and those calls are going to be expensive. So that means the spread's going to be expensive. So the trade I did was actually a broken wing butterfly to the downside. I got long puts up here. I sold 2 times of the amount of puts down here. And so if you buy 10 puts up here, then you would sell 20 puts in a middle strike, and then you would buy the same amount of puts at a lower strike. And it's a broken wing because one of the wings between the two, between the middle and upper, or middle and lower, is not the same distance. And so to capture volatility to the downside, I took advantage of selling these puts, which would profit from theta decay and imply volatility coming down. And then I bought puts closer to this in case Peloton overshot my target. It will lock in the profit, basically. So I did a broken wing butterfly trade to the downside for the Friday's expiration. Yeah, that was the trade. Richard Eisenberg says, so you're saying you should trade the opposite direction of implied volatility? No, that's situational. I'm not saying you should always trade in the opposite direction of IV. Sometimes you want to trade with IV. Sometimes you want to trade in the opposite direction of IV. It's situational, depend upon a lot of factors. But that's never, you never want to like totally trade with or against IV. There's a lot of variables you have to look into that. A couple more questions here, and then my YouTube people, and then we'll take a look at the Benzinga option score. Marino says, hypothetically, if 2 entities traded in that day, 249 million between one another, and that 250 has 0 value, therefore the analysis on the volume. Yeah, but this wasn't, that's hypothetical. It doesn't really matter for this. I mean, we can always come up with a million hypothetical situations. That's immaterial. What matters is how many people are trading it. We knew it wasn't just 2 entities trading in it. So that doesn't really apply to this situation. You know, there was lots of calls and puts being bought by individual traders across the board. And lots of people were trading this. The chance that only 2 entities were trading the stock that had the biggest news on the day, unlikely. So it wouldn't really apply in this situation. Yeah. Volume should have the amount of players disclosed. Yeah, that's debatable. I mean, I could see the value in that, but then that means that certain traders wouldn't trade. They would trade on dark exchanges where that information wouldn't be disclosed. So yeah, you would just force people on the dark exchange. E. Davis is saying, okay, sell a put, but I don't want to own the stock nor get exercise. Selling a put would actually be the trade not to take because you have open-ended risk. The stock can go to 0. And if the stock goes to 0, then you have an exceptional amount of risk. So I didn't want to own Peloton shares, and I don't want open-ended risk on a day that's incredibly volatile because it could always be more volatile the next day. So selling a put would not have been the right play on this. Andy Story says, what was the return on the trade, Chris? I don't know. I don't like look at each trade or anything like that. I make dozens of trades per week. I don't like sit there and be like, ooh, this was a 10-hour trade or 20-hour trade. It was a profitable trade. I didn't measure it against my overall portfolio or anything like that. I'll do that maybe like once a month. Which puts you bought and which puts you sold? Yeah, I already mentioned that. It expired that Friday, and I bought puts up here, and then I sold puts at like around 35 or 34, and then I bought puts lower than that. It's a broken wing butterfly. Okay, a few more questions on YouTube. Selling a call would be a good trade. No, I would not recommend selling a call in that situation. Why? Because if you get it wrong and you don't own Peloton shares, you have open-ended risk. Technically, Peloton can go to infinity. Now, I don't know about you. I've never seen a stock go to infinity, but Peloton could go from, I could be short the calls at 40. And if Peloton the next day goes from, say, 40 to 60, Or what happens if in the overnight session, there's an announcement and they say, hey, such and such company has acquired Peloton at $60 or $75 a share. The stock's going to instantly jump and kick over my stop loss. So that's open-ended risk. I wouldn't want to do that. You know, I would not want to do that. You want, when stocks are really volatile, you want to do fixed risk trades. You do not want to do open-end risk trades, because all it takes is one situation to happen to blow up your entire account. Was it worth it? No. And it will never be worth it. So you cap your risk, ideally getting into a debit strategy or something like that, that allows you to control risk in a very fixed way. So yeah, selling calls would have not been the place. You can place an iron condor, sure you can, but if it's already volatile and you don't have perfect timing, then the stock's going to go beyond your break-even strikes and you're going to hit max loss on that. So yes, you can do an iron condor, but then the volatility could be expanding still, and you could end up taking your max loss on that. And so the iron condors were expensive. And so for me, I felt like the risk to reward wasn't worth it. And so that is not the best time to be trading an iron condor. They came out the next day that would have kill every strategy you want, as news is really king. I disagree, Marino, that news is really king. I'm going to completely deal with that. Or I'm going to completely disagree with that. And here's why. We have a saying in the options market: news matters more when the market's in negative gamma mode. So what is negative gamma? Negative gamma is when the sum total of all the gamma on all the options on all the planet for whatever index, SPYs, Qs, IWMs, has a notional amount that is a negative value. You can have negative values and you can have positive values for that. If the market is net short options, then the gamma will be negative. If the market is net long options, then the gamma notional value will generally be positive. Okay. So now if that's the situation, when the market's in negative gamma mode, volatility increases, right? Volatility increases. When the market's in positive gamma mode, volatility decreases. Okay. So now if the market's in positive gamma mode, news events get absorbed. Why? Because when the market moves up, dealers through their hedging activities actually sell. So as the market moves up, dealers actually start to sell. And that means that the market is going to mean revert. When the market dips, dealers actually buy. So you get this mean reversion type play. And we can give a classic example of this in SPYs. SPYs had two positive gamma days this year. Those two positive gamma days were, I'll show you on the 1 hour chart, this day and this day, the only two positive gamma days this year. And what did the market do? Mean revert. When news comes out in a positive gamma environment, it just gets absorbed and tends not to push the markets that much. But when the market is in negative gamma mode, when the market increases, dealers actually through their hedging activities start buying the stock. They buy shares of the underlying. When the markets are selling off, dealers sell, which means they exacerbate the downside. So in positive gamma mode, dealers trade against the market. In negative gamma mode, dealers trade with the market. And so to say that news is king completely ignores an overarching fact: order flow. There are 4 types of information of why somebody makes a trading decision. And it could be one piece of information or any 4. It could be fundamental, technical, sentiment, or flow-based. Those are the only 4 categories of information that traders make any decision. And it can be any combination in between. And so bottom line is all 4 of those things have one common denominator. They all become order flow. Order flow is the most proximate driver of price action. So to say that something is king, the only thing that's actually king in the markets is order flow. And since we will never know what all the reasons were for buying and selling 245 million shares of Peloton were, we have to come down to that one common denominator: order flow. Order flow is king. News isn't king. The technicals isn't king. So it's important to understand that.
I want to give a shout out here to Randy and Sarah J here for joining here. the option school.
Welcome aboard. Welcome aboard the Benzinga Option School. If you think this is exciting, just wait until we start to get into the live classes. They're even richer than this. So yeah, news is not king. Order flow is king. It's the most proximate driver of price action. And so negative gamma, news matters more. That's why option traders say news matters more in negative gamma. It matters less in positive gamma. Because when we get that bad news in positive gamma, the market dips down, dealers actually start buying as part of their hedging activity. So it's not that news is king, order flow is king, and order flow dominates. So yeah. Okay. I'll take a few more questions, and then I'm going to just briefly go into the Benzinga Option School for the people that have the questions on that. And then we're going to get in, take a look at SPYs, and then we're going to look at some potential trade ideas for the week. Matt Warmer says, is high implied volatility good when selling a put spread? So if you're selling a put spread, you're selling a put at one strike and you're buying a put at another strike. And so there will be very specific situations where implied volatility, you'd want to take that trade or not. In terms of, is high implied volatility good when selling a put spread? That depends. If we are on the spectrum of the low, medium, and high, and yet it can still go higher, then no, you don't want to sell that put spread. You only want to be selling that put spread when volatility is tapped out and it's going to head lower. That means that to trade a put spread primarily based upon implied volatility, you have to have a particular skill in place. You have to have the skill of being able to read when is implied volatility tapped out and likely to roll over. That takes skill. That's a skill we do teach over time in the Benzinga Option School, but that takes skill. So it really comes down to volatility as a skill. Mike Axon says, is it still possible that volatility could go higher in Peloton? Sure, it's come down a little bit since Peloton is sold off. Like Peloton is now 32.83. I mean, imagine if you were trying to buy calls like right before this happened, and then you got the note from me and realized, okay, maybe this is a bad trade. How much money would that have saved you? Probably a lot. If you had also shorted it, how much money would have saved you? Now you're making double. You avoided a bad trade by getting long calls, and then you shorted it and made money that way. So now you've made money two ways. But Peloton since then has come down massively. Peloton right now is at $33. So implied volatility has come down a little bit. So in terms of your question, is it still possible that a volatility could go higher? For sure, especially since it's come down a lot. That means there's a chance, or there's more potential room for the upside than there was when it was peaking. So yes, it's a possibility. Brandon Davis says, is it possible for the stock to go above your break even before it hits its final target? For sure. Depending upon the structure of the option, how many legs, where your break even is and everything like that, it's always possible for that, for sure. But if you're buying a debit spread, no, when you buy it, when you're paying for a debit spread or paying for a debit option, like a broken butterfly like that, your max loss is already achieved from the moment you pay for it. Whatever you pay for that, that's your max loss. There's no more money to be lost on this. Nicolay L says, Rodrigo can answer that question there for you. Andy Story says, what would be the max loss on the broken wing butterfly? That depends upon the cost of each individual strike. There's no fixed answer on that. But the max loss is whatever you pay for it. So on a broken wing butterfly, assuming that you're doing it like this, so that the space between this one is greater than the space between these. So assuming that's what you're doing, the max loss is your debit from the outset. There's no more money that can be lost on this one. It doesn't matter if the stock goes higher, or it doesn't matter if the stock goes all the way to zero. You've already hit your max loss. It's a debit strategy. You've hit your max loss on this. There's no open-ended risk, assuming you construct it this way. If you construct it the opposite way, where these puts are closer, and then you have another put way down here, then your max risk is much more open-ended. But under this construction, your max list is your debit right off the bat. Okay, 3 more questions, and then we will, or 2 more questions, and then we will, 1 more question actually. is there somewhere to see negative gamma mode, or we have to look at the charts? We actually, so there is nothing in the charts that will do that. I have a proprietary app that collates all the data. It collates all the notional gamma. And then I share that with the Benzinga Option School members Monday through Thursday in a pre-market commentary. For example, right here, February 14th pre-market commentary. That's today. I started a, hey, we're in negative gamma mode. So expect volatility moves and things like that. I share that every single day with the Benzinga Option School members. If you have a proprietary app that can collate all the options and SPYs on the planet, and then all, for all strikes across all expiries, and then summate all that data, and then summate all the gamma, and then come up with a notional quotient, then you can do that. But if you can't do that, well, then you can join the Benzinga Option School and you can get it every day. I provide it every single day, Monday through Thursday. Fridays is a different day. I have a couple people that are posting questions. Again, reminder to my Zoom people, if you post your questions, post them in the chat, not in the Q&A. I'm only looking at the chat right now. Okay. All right. I've covered all the, I've got one more question, and then I'm going to move into the Benzinga Option School real quick. Marina says, gamma for the specific market, or is it a market average of all markets? So when I provide gamma, I'm talking about SPYs. I do on occasion share for Qs and IWMs, but notional gamma is for that particular underlying. And since SPYs is the biggest market and the closest proxy for the market, that's generally what I'm referring to. Every now and then I'll share Qs, but Qs is not the same size as SPYs. SPYs is the largest, you could say, index or ETF in the world. Therefore, it's considered the closest proxy for the market. So yeah, but gamma would be specific to the underlying. Each underlying has its own notional gamma. Okay, I've covered all the questions on this. So let's get into the school real quick. Rodrigo, can you remind me of the questions that the members had so I can answer them real quick?
From the chat, or?
You were saying you had some questions about, people were emailing questions about the Benzinga Option School. So I just want to make sure they're getting the right questions.
The syllabus is, maybe we can show them the syllabus too. I don't know, maybe sneak peek there, Chris.
Yeah.
And kind of go over it a little bit. Because I know that a lot of people that are new, they it's just good for them to see all the lessons, because I mean, you've done the math, right? Like, it's just a great deal for them to get you as an instructor, teacher, mentor, like, yeah, for the year, all that stuff.
Yeah. So members of the Benzinga Option School get access to the course for a year. The way the course works out is this. So we have 2 sets of lessons here. Okay. 8 lessons in total, and we've structured them from like kind of the foundation and then working your way up. Okay. In week 1, we do lessons 1 through 4 on Monday through Thursday. That's Monday through Thursday. That's my awful handwriting. And then in week 2, we do the lessons 5 through 8 and Monday through Thursday. That's a 2-hour session in the morning. Okay. And so we go through these various topics. Like the first one has to be introduction to options, explain all the mechanics, terminology, so that everybody's on the same playing field. If everybody's using a different language, we're not on the same playing field. It's impossible to move forward. And then we kind of dive into the Greeks, which is an incredibly rich lesson in and of itself. We talk about volatility. Remember how I was mentioning that volatility is a skill? We have an entire lesson on volatility. And then we get into single legs, 2 legs, 3 and 4 legs. Then we combine price action. So you understand what is the price action you need to see with each particular strategy. Because we teach like 15 to 20 strategies. You need to know what the price action looks on the chart and if that's the right price action for the right strategy. If you use the wrong strategy with the price action, you're going to be using the wrong strategy at the wrong time and you'll be wasting money. So we teach you what is the patterns that you want to see for each individual strategy. And then we start talking about market gamma, which is talking about the the overall position in the market, negative or positive gamma. What's the dealer positioning and what kind of hedging activities are they taking, which are generally reflexive. So we talk about that and how that will affect the markets on the day and how you can use that for trade strategies for each day, basically. So we talk about that in these 8 lessons. The way it works is we have 2 hours of each one of these lessons in the morning, and then we do open Q&A in the afternoon. And the open Q&A in the afternoon, Monday through Thursday, is when we go over student trade ideas, I literally analyze all my students' trade ideas in real time, give different recommendations like, oh, this is a great trade. I like this one. Oh, I wouldn't take this trade. I would avoid this. Oh, this is a good trade, but adjust your strikes like this and maybe move your expiry to this. Like every single trade they post, I go over them in detail. So imagine what it is to have that kind of feedback on all your option trades. That's the Q&A session we do in the afternoon. On Friday, we take a demo account. We place trades of each strategy that we go through so that people can see me walking through it, how I analyze it, what I'm looking for, and then they can have the experience of watching these trades manifest in real time and how they play out. So you get that live experience in real time. That comes out to 50 weeks of classes. I take 2 weeks off. You get 3 hours per day, Monday through Thursday, plus 1 hour a day on Fridays. So that's 4 hours a day. Total of, what is that? 150. I think the math comes out like this. 50 weeks times 3 hours a day times 4 days a week, 600 hours. And then you get 50 Fridays. So that's another 50 hours. So 650 hours. And the price, I think, is what, $12.97? So $12.97 divided by 650, you are paying $1.99 per hour of live instruction. Find me a place on the planet where you can get that for $1.99 an hour from a 2-decade veteran, former broker on Wall Street, former hedge fund trader. You're not going to find it. Not going to find it. It's only because it works in scale that it actually works for me. Otherwise, this would just be the most ridiculous thing I've ever done. So you're paying $2 an hour for live instruction for somebody to analyze your live trades, and you get access to Benzinga Pro. To me, it's a no-brainer. I would have paid multiples of that to get that live instruction when I first started trading 20 years ago. So yeah. Okay. Anything else you want me to cover on that, Rodrigo, before we move on?
Yeah, I think I already know kind of that you also provide the trade ideas, like, with the chat room there. So there are multiple benefits. It's not just learning, but you can bank with Chris too.
There's a student trade idea section where they post their trades and their ideas. They post charts and everything like that. And we literally analyze every single one. Like we analyzed all these trades today. So if you have a trade idea, you're thinking about trading it, and you're sitting there going, I don't know, maybe should I take this trade or should I take this trade? You post it. I analyze in real time and give you feedback on all these trades. I wish I had somebody 21 years ago to bounce my trade ideas off of and be like, hey, this is what I'm thinking. What do you think? And them give me live feedback in real time. Would have saved myself tens of thousands, if not hundreds of thousands of dollars back in the day, avoiding a lot of bad trades and then also making better trades. To me, it's a no-brainer. If you end up avoiding making less bad trades, you've paid for the course itself. And then on top of, you make more good trades, you've then paid for the course by several multiples. So it's a no-brainer. Okay. With that being said, I'd like to move on. So put a 10 in the chat if I can move on. Let's see those 10s. Yes, very nice. Okay. I wish I had this 2 years ago. Burns, you're in the class now. Nancy, you're in the class now. So, you're taking advantage of now. You're making the best of this time now. That's all that matters. There are 2 days of the year we can't do anything about. That's yesterday and tomorrow. Only today. So you're doing the right thing today. So that's what's important. Okay, Julia has a question. Julia, before we do any call outs, we got to finish through our material, and then we'll have some open Q&A for call outs at the end. So yeah, we'll get into that in a little bit. Okay, so let's kind of step back and let's kind of do some analysis on SPYs, what's going on in the order flow positioning, and then how, I'm looking to trade this week, what I'm looking at, and what are some trade ideas. One of the trade ideas I'm going to share with you today is actually a trade idea that one of our students came up with. And we looked at it and came up with some adjustments, and we feel like we've come up with a good trade idea. Well, let's start with talking about SPY so we get an overall understanding of the markets. Okay, so right now the market is in negative gamma mode. That means we should be expecting volatility throughout the week. Generally, until we get into positive gamma mode, we should be expecting moves of 1 to 1.5% throughout the week. And it kind of makes sense because we got some risk events out there that could kick up volatility in any direction. For example, the Russian troops on the border of Ukraine, if that escalates in any sort of situation, then you can expect us to enter a risk off event where traders are not taking on risk. They're actually trying to de-risk their trades in their portfolio. And so if that's the case, then we would expect a couple things to happen. We would expect SPYs to sell off, and we would expect VIX to spike. Now, prior to today, I haven't looked at the most updated today, but prior to today, SPYs had about 5.9 million calls and about 11.7 million puts in the market. That means it's a put-dominated market right now. Puts are in control. And the way it's kind of lining up is it's not just that the SPYs has about 2 times as many puts as they do calls, 6 million calls to roughly 11.7 million puts. That means there's about 2 out of every 3 trades is a put. It's also that the call volume is very thin across the strikes above current price. So because it's not collated around the current strike, which is around 440, we're seeing a lot of calls that are just kind of spread out between all these strikes above. That's problematic to some degree because it's not enough to pull the market higher in and of itself. On top of it, we're seeing lots of puts, and I'm drawing these bars as kind of a reference of the size of volume of the puts at these strikes. We're seeing a lot of puts, at or down to kind of this 430 area. And then the puts start to decline kind of in open interest in size. So it's a put controlled market. In some sense, that's bearish. If traders are long puts, dealers are short puts. If dealers are short puts, then they have risk to the downside. If you're short put and the market goes down, those puts lose value, or they actually gain in value for the put buyer. The dealers start losing money. So how do they hedge that? They get short shares. That takes liquidity out of the market. When dealers short shares, they are pulling liquidity out of the market. That exacerbates moves to the downside. So in one sense, we have this kind of negative gamma fragility or instability in the markets that if something bad happens, the market just sells off aggressively because dealers have to sell to hedge their exposure. So this is, on one sense, a bearish situation. But on the other sense, there's actually a contraindicating force, which is that if we are in a put-controlled market, what it means is that as the market starts to consolidate, those long puts start to lose in value. And if they're already expensive, well, then if somebody overpaid for those puts, they need the market to keep ripping down for those puts to gain in value. If the market starts going sideways and VIX starts coming down, they're losing money on 2 fronts. They're losing money on implied volatility going down, and then they're losing money on theta decay. So the market actually going sideways is a problem for this large position of puts out there. It means that they're eating theta decay every single day, and then implied volatility is coming down, so they're losing on vol as well. So in one sense, the market is fragile. It's just got this fragile positioning to it. That's why we've only had, like, every time we get above like 451 here, you can see since January 19th, every time we get above 450, we're there for a day, and then something happens that pushes us back down. We get above it for a day, and then something pushes us back down. We try and rally, and there's troops building on the border. So the market is kind of in this fragile mode that rallies, they're not holding. That's a problem. But then we have this other contraindicating force, which is, well, if the market goes sideways, those puts are going to start kind of losing value, and that will put pressure on those long put holders to close them or monetize them. And so we got 2 contraindicating forces. So how do we trade that? I think for right now, traders should be expecting volatility throughout the week, and that we should be selling rallies with fixed risk strategies, meaning that if the market does rally, to avoid getting too much, stopped out for too big a loss, we just have fixed risk strategies that cap the risk, they keep it contained, and that if the market does explode higher, which is a potential in negative gamma environments, if the market does explode higher, it's not a big deal. It's just a small amount of risk, water off the duck's back, no big deal. And yet, if we're right, and that fragility comes into the market and it does sell off, well, then we take advantage of that. So I think traders should be selling rips right now with fixed risk. If you look at the 5-minute chart today, you can kind of see an example of this. What's the biggest move on the day right here? This one. You see how fast it sold off? Look how long it took to buy up. From here, I mean, this actually sold off double this move. But this move from 8:15 Pacific to 9:50, so about an hour and a half, went from 437 up to 4. It went about 4 points. And yet, from 10:05 to 11:05 in about an hour, so less time, sold off double. That's the fragility in the markets. That's negative gamma mode. When the markets sell off, dealers sell. So that means the moves to the downside get exacerbated. And so I think traders should be selling these pops higher with very tight risk. And if they nail it, they're going to get one of these little moves and they're going to make a lot more than it took to gain to the upside. So I think that's one play for the week, for sure. I think traders should be selling those rips with fixed risk on it. Any questions on that before we move on? Rural Black says, Chris breaking it down. I appreciate it. I'm glad you're enjoying this. BB calls? I'm not sure what you mean by BB calls. Okay, put a 10 in the chat if there are no questions. Rips means rips higher. Yeah. Like they will often say like sell the rip, buy the dip. That's what I'm talking about. Broken butterfly. We call that BWB. So we call BWB for broken wing butterfly. Yeah, I think it's a viable strategy. Jose Hadishinger is saying, what time frames do you use for for this kind of trades? So I do it all. I day trade, I swing trade, I hold things for like medium long-term amounts of time. I do buy right strategies. I do it all. For strategies like this, I would say short-term, anywhere from, a 5-minute chart up to like a 1-hour chart, because negative gamma, positive gamma, they're kind of like the weather conditions for the day. And this is why, understanding market gamma matters, because whatever the market gamma is, it's going to kind of determine the weather for the day in the markets. And if you don't know that, if you're saying, hey, I'm going to get long calls, but the market's in positive gamma, you're probably not going to get the rip that you want. On the other hand, you could be saying, you know what, I'm short volatility today, and yet the market's in negative gamma mode. Again, you're probably not going to get what you want because you're not paying attention to the weather. Gamma, overall notional gamma, is the weather in the markets. And our job is to understand that. Gamma can change for every single day, but it often stays, the way it is for most of the week. So for me, I would probably need to see SPYs above 450, 451 and have it hold there for a few days to build up some goodwill, so build up some positive gamma. Until that happens, we're in negative gamma. So I would want to be, generally long volatility and looking to sell rips for the rest of this week. So you could do this on a 5-minute chart. You can do it on a 1-minute chart. On a 4-hour chart, you're probably holding the trade for weeks, and market gamma can change, inside of a week or several weeks. You could have 2 to 3 market gamma environments over a course of a month. So I wouldn't look to hold this that long. So I would say anywhere from days to maybe, the rest of the week kind of thing, or maybe a week or two max. Can we find on our own the gamma variable somewhere? It's not like you can just look that up. You would need an application that could collect all the options on SPYs on the planet through all strikes and all expiries. Then you would need to summate the gamma notional for each strike through each expiry, collate all that into a notional amount, and then figure out is that negative or positive and go from there. So that would be the way to do it. I hate you. Yeah, that's why you build an app for that, or you join our school and you can get access to that. Kay is saying, so it looks like the 9 is riding the 20. That's an indication of it going down. Now, right now, the thing's going sideways. So EMAs are flat. When the markets go sideways, EMAs are useless. EMAs are only useful when you're in a trending direction. When you go sideways, they're not that useful at all. Yeah. Okay. Put a 10 in the chat if you are ready to move on. But the puts and call gammas are both positive. Yes, but you got to understand that gamma has positive conditions and negative conditions. So there are times where gamma will add to the deltas, and there are times that it will negate or subtract from the deltas. Those matter. That's how gamma can have a positive condition. For example, if you are long gamma, let's say you're long calls, and the stock goes up $1, and you have a 50 delta, well, it goes up by the value of that 50 delta plus the gamma. But if you're long calls and the stock is selling off, then the gamma actually is taken away from the delta. And so you have to start collating all that stuff. Yeah. Could you use the UVIX as an indicator? No, that wouldn't really accomplish that. Okay. All right. Let's go ahead and move on to the next part. Okay. So, all right, moving on. So I think, if we start to look at some possible plays for this week, obviously energy, obviously oil is going to be a big thing. It already has been gaining for a few weeks now. Oil's been a hot trade for pretty much most of this year. And if Russia was to, say, invade Ukraine, well, that would create all kinds of tensions with oil. So one of our students today brought up a potential trade idea in XOM. And I like the idea, but I felt like we needed to wait a little bit on XOM before we kind of take this trade. So first off, let's take a look at XOM. Let's start off on the weekly chart and kind of get an idea. So I've been saying that XOM is been bullish all year, oil's been bullish all year. And we can see the stock opened the year around 61. Now it's just under 79. Very, very strong return, year to date so far. I mean, what is that? 30%? Very impressive. Very, very impressive. And as geopolitical tensions between Russia and Ukraine heat up, it's only going to put more pressure on that. Also, if we start getting new bouts of coldness this winter, it's going to create more pressure on that as well because people consume more oil. Okay, so when I look at this, I see a very strong trend. This 2-week pullback is pretty corrective. Like in the last 2 weeks, we've barely pulled back half of the gains on this candle alone. So we've had over 2 weeks, we've lost ground to a point that's only equal to half the gains on the prior week. So to me, that's like a very corrective move. On top of it, when I look at it on the 1-hour chart, so look at this on the 1-hour chart, what do I see? Here's that corrective pullback. And yet look at volume. Volume has remained steady throughout the subtle gain and the corrective pullback. Volume has remained steady. It even spiked a little bit on this day. So volume has remained steady. That tells me that real money buyers, people who are buying the shares outright, they're not fazed by this pullback. They're buying these dips. If I was seeing volume decline with that, then that would tell me real money buyers are slowly de-escalating their purchases. But they're not. They're maintaining an even keel on dips. As the price is getting worse, they are happy to buy it at these cheaper prices. That to me is a sign of strength in and of itself. On top of it, when I look at the overall positioning in XOM prior to today, I see about 530,000 calls. I see about 427,000 puts, with about roughly 35% of that expiring by this Friday. So a lot of these options are going to be coming off the board, this Friday. That could create a potential pullback, considering there are more calls than puts. On top of it, when we look at our platform here, we can see on the trading day, it's a material amount of options traded on the day. 442,000 options on a stock that only had 950,000 options prior to today. So that's almost, what is that? What is that? 442 divided by, say, 960. 46% of the options traded in one day. And more of these were calls than puts. So traders are buying calls even on the dips, more so than they are buying puts or selling puts. So we have call heavy positioning. And so when I look at that, I feel like, okay, traders are buying on dips. They're happy to buy at these prices. We do have a fair amount of options coming off this Friday. So unless the stock pops Tuesday, Wednesday, Thursday, by Thursday or Friday, I don't want to be buying calls per se, because there's a fair amount of options coming off the board. That's going to kick up volatility. And since more of the options are calls than puts, there's a chance the market pulls back this Friday after the monthly OPEX. So I either need to be buying before that and try and avoid theta decay, or I need to be buying after that. And so we kind of feel like when I look at the overall option positioning, I feel like XOM is relatively supported, but we may pull back a little bit deeper. And so I think XOM can pull back anywhere between, say, 76 and 74. You can see that if I kind of zoom into this a little bit, you can see there's a material amount of support in price action here. Resistance here, a little bit of support there, support through all this, nice corrective structure, breakout, nice volume on the breakout with earnings. It's what we like. So nice little structure. So I think the market could find its way back towards 76. Now, XOM, other than earnings, it has these occasional rips, but then after the rip, it tends to consolidate. It rips and then it consolidates. So when I look at that, I feel like, what? If we were to get back in here, I would either get long a broken wing butterfly or a call broken wing butterfly, or I just get long a call butterfly with maybe $5 white strikes on this. So I think XOM probably by next Friday, other than something new happening in the conflict between Russia and Ukraine and all that, I think XOM probably stays between 76 and 83 next week. So I could get long broken wing butterfly, which would be long calls here, maybe sell some calls up here, 2 times the amount, and then buy calls a little further up. Or I could get long and even call butterfly, which would be long calls and then short calls and then long calls and even width. I think both of these are viable strategies. If we do decide to take a trade idea like this, then I will post the live trade idea with my Benzinga Option School members and then share that trade with them, strikes, expiry, the whole thing. So that's kind of where I'm leaning to on this. Andy Story has a question. Do institutional option sellers move the price of the underlying security to cover their positions? So do they move the price of the underlying? Okay, Andy, are you asking, do they take other options to move the price? Or are you asking, do they actually buy or sell shares to move the price? Those are 2 different questions. Yes, they can. It depends on whether they are a dealer and market maker or not. Dealers and market makers have reflexive activity. So depending upon what options they make markets for, like, for example, if I was to buy 100 XOM calls, well, the dealer is short 100 XOM calls. And so they will have to hedge that through actually buying shares. Because if they sell calls and the market goes up, they start losing money in those calls. How do they hedge the risk? They buy shares, right? That's their hedging activity. So dealers and market makers will buy and sell shares based upon their hedging activities. Now, there can be institutional traders or outfits that are not dealers and market makers. They take directional positions. They have a proprietary book. And so they could have option trades. And if they feel like, hey, we may need to buy 100 million or 200 million shares to keep this thing supported, they will do that. If they have the capacity and it's available on their book, they will do that for sure. But it just depends on what kind of book they have, if they are like an actual proprietary institutional desk or not. If they're a dealer, then they're doing it reflexively. They're just doing it to hedge their positions. They're not trying to take positions, directional positions outside of their hedging book. There are some dealers and market makers that will buy protection on the wings in case of extreme events, but that's, much in comparison to their total option activity. It's like a very small percentage of the time. Yeah. No, I'm not saying to buy calls. that I haven't picked any strikes or anything like that, Jorge. When I do pick the strikes and it's time, I will let my Benzinga option members know what strikes, what's expire, everything like that. K Smith has a question. How does the retail trader hedge? We can't buy millions of shares. So there are many ways to hedge. The best way to hedge is through options. So if you own shares in XOM and you are worried about a price decline, well, then one of the best things you can do would be to buy protection to the downside. You can either get long puts or you could sell calls. Now, selling calls is not a true hedge. It will neutralize some of the risk and it will lower your cost basis, but it's not a true hedge. A true hedge is you're long shares and you're buying puts so that if the market does go down, those puts start gaining in value. So that is a true hedge. If you're long shares, then the best way to do it is to get long puts to hedge the downside. If you are long options, then you can either use other options to hedge your position, or you can buy and sell shares depending upon what position you have in the market. So if you are long shares, then you would hedge with options. If you're short shares, you can also hedge with options. If you are long options, long calls or long puts, then you can hedge with options or you can hedge with shares. So hopefully I answered your question. But generally the best way to do it is via options because it's cheaper. When you get long and short shares and things like that as a potential hedge, then you're putting up much more margin. So it's much easier to hedge options with options because you can hedge via the delta. With shares, you buy shares, you're a delta 1. You're at a 1 delta. So yeah. Brendan Davis says, broker wing butterfly. Is this a picture that we are supposed to see within the graph? Not really. The broker wing butterfly is just a name for the option. When you look at where the strikes are positioned and then how the P&L kind of works out, it kind of creates the image of a butterfly if it's even strikes. And if the strikes aren't even, then it kind of creates like an uneven picture of the wings, so to say. So yeah. Jorge is saying hedge with options with which delta value. That would depend. That would depend on how much you want to hedge. So it depends on your position. There's no fixed answer to that. That would depend upon how long deltas you are. It would depend upon your share position, depend upon all kinds of things. So it depends on, there's no one answer to that, Jorge. Okay. Let's go ahead and move on to another potential oil play. BTU. BTU has been doing very well. One of our students bought calls at 12 way back in the day, closed it out at like 16 something. I think it was Baghdadi. He's one of our more active students. He did very nice on that trade. I think it was Baghdadi. Baghdadi, are you here? I'm not sure if you're here, but if you are, congratulations on that one. So just a great job on the calls on that one there. So BTU, in my opinion, is getting a little overextended. You know, and I'm suspecting this partially because of the curvature of the price action after earnings, but also what are we seeing? We're seeing share volume decline materially as it continues to go up. So this may be getting exhausted soon. If it doesn't have a new exogenous catalyst or something like that, and it doesn't have a new rush of shares coming in, this might be getting a little bit of exhausted. But when I look at BTU prior to today, had about 100,000 calls and about 40,000 puts. Here's the real challenge with BTU. So of the 150,000 options, again, this does include today's flows, about 50% of those are coming off the board this Friday. They're expiring this Friday. And since 2 out of every 3 options is a call, we have to suspect or assume that more of the calls are coming out of the market than puts, which means that support might start to come out of the markets this Friday. So I'm expecting volatility to start increasing on BTU as we get into like Wednesday, Thursday, and Friday, when the time decay measures start to really accelerate on, or time decay pressure start to accelerate on those long call options. So when I look at BTU, I feel like it's a little extended from support. And so I would like to be long BTU between say 14 and like 16. So I'm going to wait till, you know, if there's no new exogenous catalyst like Russia and Ukraine situation or something like that, then I'm going to wait till like Thursday or Friday and look for this to start to pull back as these options start to get monetized. And then once it starts to pull back to a good level, then I'm probably going to get long. I'm probably not going to get long calls. I would probably either do a bulk call spread or maybe a call broken wing butterfly to the upside. Again, when I do post the live trade for my members, I'll share, the strikes and expiry in for the Benzinga Option School members. But I do think this is going to pull back soon. I think it's a little too elevated right now. And my overall suspicion is that as we get later in the week, it's going to have more and more of a headwind because of all the options coming into the market. So I'm going to wait. I'm not going to chase this higher at this point. I think it's getting kind of elevated. Also, on a higher time frame, we're getting pretty close to resistance. There's some major resistance above here at 1930 and 20. And if you've been long since 13, you're long shares. Are you going to be taking profit at 20? Yeah, most likely. So I think we're probably going to make a decent run. We're at 1828 in the post market. I think we maybe make it to 1930, maybe get a touch of 20 without a new catalyst. But then I think the market starts to stall as we get late in the week and pull back. And then when that happens, I'll look to get long, maybe shares, maybe options in shares or just options. But yeah, we'll see how that plays itself out. Yeah, or I might not do a bullish spread. I might do a broken wing butterfly. I might do a ratio spread. I haven't decided. Yeah, I haven't decided. There's a lot of things that I would, a lot of potential ways I would play it. Could be a vertical, could be a broken wing butterfly, could be a ratio spread. There's a lot of different ways I might play it. If I think volatility is going to come down after the expiry, then I may get long a call butterfly and even butterfly. It just depends. Yeah, just depends. Marino says, in your lately personal trading, what is the winning ratio? I think you meant in percent towards total trades. What is the winning ratio? I average around 60% winning trades. My accuracy fluctuates a little bit up, a little bit down, but generally around 60%. Over the last 2 years, I generally hover around 60%. Yeah. What is the time frame is considered a long put? When I speak, I say I'm buying a put. Buying a put by itself does not denote a time frame. Not at all. The time frame will be relative to the expiry that you choose. And so the expiry is basically the final date that you can achieve your goal with that option. Do you think it'll take you a week? Do you think it'll take you a month for your thing to achieve that goal? However long you think it'll take for you to achieve that goal is how long you should create the expiry. No more than that. If you think it'll take a month, then you want to set it to a month. If you think you'll take it for a week, then you want to set the expiry to about a week. But trading a long put or anything like that doesn't fix you to any particular expiry or time frame. And if you are looking at a weekly time frame, you generally only be, if you're looking at weekly expiries like this Friday, you don't want to be looking at per se weekly charts because it could take multiple candles for that to achieve its goal. So you need to be looking at lower time frames. It's a relative question on that. How many times are you correct on the go? I think I just answered that, Marino. I said I'm on average 60% accurate. That means that on average, I win 6 out of 10 times. That also means that I lose on average 4 out of 10 times. And to me, I'm very comfortable. I'm very comfortable. I have no problem losing because I'm going to lose on average 4 out of 10 times. You seem to see a lot of information on the today's option statistics. I don't know what you mean by the today's option statistics. I have no idea where that is. Oh, you mean on the platform here. On this, do you mean this, Jorge? Okay, yeah. That's super simple. You just pick your ticker, you go to trade. Here's all the different expiries. They have these 3 tabs here: option statistics, time in sales, and then they have product depth. Why did that just lock me out? That's weird. That just totally locked me out. Oh, okay. I got locked out for a second there. I just use this if it's been a high volume. Like if I'm short-term trading, I kind of want to know what's the volume on the day. The volume on the day is like looking at the volume of shares for a stock. So this tells me how many options were traded on the day, and then I can start to make certain assumptions based upon that. Yeah. Lisa Gann, what is the drawdown when you lose? I risk 1% per trade, but that's me. Everybody can choose whatever they want. So when I trade 1% risk per trade, so every loss is just 1% for me. Marina says, no, I meant you open a position, but you change your mind. Oh, how many times do I correct on the go? I manage all my trades. All my trades are managed. Very rarely are they set and forget. I would say maybe 20%. Yeah. But we're kind of getting focused on my trading and not options. So yeah, I kind of want to redirect it back to options. Yeah. Okay. So we've covered BTU, some potential oil energy plays. I think there are opportunities potentially in RSX. RSX is an ETF for the Russia index. And so it kind of basically tracks some of the biggest stocks in Russia. And outside of a new catalyst, I think we're starting to get a little bit low in RSX. RSX was at, like when this whole conflict started a few months ago, was at almost $33. Now we're at 21. And if you're 23, and if you step out over a long time frame, we're kind of in fair value. So for long-term holders, there might be a play here in RSX because RSX has one of the most gangster dividends in the market. 6.5% right now. It's huge. Now there's certain risk in owning RSX right now because if the conflict escalates, you're going to probably see this sell off crazy. So I wouldn't want to just get long shares without having downside protection. But I am noticing that the volume of shares is increasing. And I think eventually we're going to hit a fever pitch in this. If there's no military conflict and things are resolved peacefully, you're going to probably see RSX start to regain. Prior to today, RSX had about 210,000 calls and about 300,000 puts. That means it's slightly put dominated. And about half of those are coming off this Friday. So RSX is going to start to get a lot of volatility coming into the market come this Thursday or Friday as a lot of these options come off. Literally half of the 500 plus thousand options are coming off the board. That's going to move the markets a little bit. So I think volatility is going to be bid in RSX for the rest of the week. And then we're going to start to see, what's going on with the conflict. Is it escalating, de-escalating? I think once the conflict starts to de-escalate and we've kind of, so to say, crossed the Rubicon of there's less likely to be an issue, then this might be a really good play, medium and long term. We're not there yet, so I don't recommend getting long shares without having downside protection, but we could be getting towards the bottom in RSX pretty soon. Not there yet, but we could be getting there pretty soon. So, if you look at over the last, since 2012, we have a relative floor around 14. We have a relative high around 33. So that's roughly, we're almost fair value right now, almost fair value. So for long-term holders, RSX is not a bad play at all. Just make sure you protect the downside. But once it does start to bottom, I think this is going to be a really good ETF to own. So I do like this as a potential play in the future. Case Smith says, in the boot camp, do you teach how to use this option chart? Do you only teach for certain platforms? That's a great question. I myself do not use all platforms. I only use one platform. I can't learn all platforms, nor can I teach all platforms. I don't teach people how to use individual platforms because one, there's hundreds of platforms out there. And so if I teach one and I isolate, then it really makes it hard. I just focus on the platform I use, but I just tell everybody, hey, whatever platform your country allows you to use, because in different countries, they allow certain platforms that don't allow others. Find the one that best works for you. I'm pretty sure that whatever platform you're using, they have tons of free videos on how to use the platform. I feel it's best to be using my time to not be a technology educator. Like, I don't want to spend my time teaching people how to use the technology when the education is free on YouTube. I'd rather teach them how to trade options. And so, yeah, I don't really spend a time during the live class teaching technology because not everybody's going to use the same technology. So I just focus on teaching them options. Yeah. Should we be learning on TD Ameritrade? I like that platform. It's my favorite. IonQ rocket ship. What are your initial thoughts on IonQ? Stock just doesn't seem to slow down. We'll take a look at callouts in about 10 minutes. Redbush is saying, what tools do we need to be a successful attendee? Do you mean for the Benzinga Option School, Redbush? Is that what you mean? I know there's a little bit of a delay, so let me know. Let me know on that. While you're answering that question, let me get to another one. Jorge is saying, what type of credit do you look for on a diagonal credit spread? Let's say a 10-point spread, and what deltas to use? There's no fixed answer to that, Jorge. I'm not an algorithmic trader. Like, if you think about it, there are many things that influence the price of options, right? Volatility, time, are we low or high volatility? Where are we in relationship to the strikes and price action? Moneyness matters. Moneyness, time, and volatility affect all the Greeks, and all the Greeks affect all the pricing of options. So there's no fixed answer for that, Jorge. Like, it would be like saying, hey, what are the 3 traits I look for in a girlfriend? It's not, people are complex. Options are complex. You can't, I think it doesn't really help. I understand the need to want to look for simple answers, but trading stocks, just buying and selling shares of stocks is like checkers. Trading options is like chess. And there are a lot of complexities to it. And my job is to demystify that and then give skills and strategies so they can help build the strategies that they want to. So there's no fixed answer for that. Yeah. It's just the markets don't care about fixed variables too much. They're going to do what they want to do. Is the market in positive or negative gamma? Is the market experiencing a big surge in options, or is options volume low? Is IV high or low? What are the deltas? It's like there's a lot of variables, a lot of moving parts. There's no fixed answer for that. What indicators do I use? Just VWAP and volume generally. Yeah, if you look at all my charts other than my intraday charts, just VWAP and volume. Do I know that I'm the best Italian? I'm actually part Italian, so thank you. I appreciate that. The recording will be made available later. Okay, Redbush is saying yes. Okay, what tools do we need to take part in the Benzinga Option School? You're going to need at least the demo platform, and anything beyond that, I don't think you need anything else. The Benzinga Option School comes with Benzinga Pro, so it comes with that. You get a year subscription to that, which is amazing because Benzinga Pro is normally like $2,000 a year. You get that free with the Benzinga Option School. So you have that tool. You need some charts, but your charts should come with your platform. So if you have a demo account platform with charts, you're pretty much good to go. You don't need any tools beyond that. Do I have a standalone monthly trade service? No, it's only in the Benzinga Option School. Will I teach us about VWAP? No, I already have free videos on VWAP. There's no point in teaching about that. VWAP is not a part of options. It's a technical indicator. My teaching in the course is focused on options. I have free videos on my YouTube channel for that. Okay, one more question, and then I want to start doing call outs. For call outs, the way it works out is this. If you have a trade idea, then you got to share with me the symbol, the time frame, 1 cent subscription, bullish or bearish, and the trade idea itself. If you don't have a trade idea, then you got to share with me the symbol, the time frame, and 1 cent subscription, bullish or bearish. I'll do about maybe 5 or 6 call outs because we only have about 30 minutes left here. So is there an optimum period for time decay? Well, that would depend. If you're selling options, then the greatest amount of time decay always happens or accumulates in the last closest days to expiry. If you are long options, your long calls, long puts, or whatever, well, then you want to be as far away from expiry as possible and achieve your goal as quickly as possible. So if you're long options, time decay is your enemy. As we said in the Benzinga Option School, time decay is the thief in the night. Every single day you hold your option trade open, if your long calls or long puts are now long options, you're going to experience time decay. And so that means the value of those options gets less and less over each day. And so you want to achieve your goal as fast as possible. If you're selling options, then you want time to pass. And the greatest amount of time decay occurs in the last closest days to expiry. So yes. Okay. Nancy Burns is saying, Chris is the best teacher mentor. Benzinga Option School is great. Buy regardless of your skill, IMO. Thanks, Chris and Rodrigo. Good night, y'all. Good seeing you, Nancy. I'm glad you could be here, and I hope to see you in class tomorrow. Okay. So let's do a few call outs. I'll take the first 5 call outs. And then maybe, well, I'll take the first 3, and then we'll see how much time it takes for us to do that. And remember, instrument, time frame, 1 sentence description, bullish or bearish. And if you have an actual trade idea, post your trade idea. Keep in mind this exercise that we're about to do. This is an exercise I do with my members every single day. So just imagine what it'd be like to have that access in the Benzinga Option School. Okay, Jose's got the first out. WMT, daily, bearish. Okay, let's take a look. Okay, technically I'm lining that way. It does have a dividend. Okay, let's get rid of some of these lines real quick just for a second. Let's get a relative floor in here and a relative ceiling. Okay. And let's look at Benzinga options, or not Benzinga options. Let's look at total option flows. And let's pull up the platform and see what kind of options we had on the day. Okay. So prior to today, Walmart had about 342,000 calls and about 250,000 puts. So slightly call dominated. So that was it's almost 600,000 options, about 590,000 options, almost 600,000. Of that, about 30+% are rolling off this Friday. So this Friday, you're kind of seeing a theme. There's a lot of options coming out, and that's typical. Monthly expiries generally have the largest amount of options expiry in any given month. So a lot of options coming off this month. Okay, so over 30%. So roughly of the 600,000 options, you're talking roughly 200,000 options are rolling off this Friday. Today alone, the stock traded 139,000 options. That is significant. So let's see here. 139 divided by, let's just say 600. Okay, 23%. Okay, so 23% of the options. Slightly more calls than puts. Okay. I would agree with your bearish sentiment. Other than the options expiring this Friday, a lot of the options are more long dated on Walmart, which means that the majority of option traders in Walmart beyond this expiry are not really short-term day traders. They tend to hold options for longer periods of time. That's because the gamma curves in terms of dealer hedging impacts are flat. Gamma is flat generally over a longer time frame. So, other than this Friday, you don't have to worry about short-term hedging impacts. I actually think it's a decent idea. Who was that was Jose. So yeah, I like this idea. Where would I want to sell? As close to 140 as possible, but I'm not sure we're going to get there. Yeah, I'm not sure we're going to get to 140. Refresh this for a second. 134. Give me a second. Let me check my data. And I will take the first one in Zoom, and then I'll take the first one in YouTube, and then we'll just keep rolling forward. So this way everybody gets a chance. Okay. All right. So the data is right. Okay. I would probably look to sell as you start getting close to 135, between 135 and 136. Yeah. Yeah. I like this idea. Who was Jose? Yeah, I like this idea. Yeah, it's a good idea. IV is probably not really rich right now. We can check, but I don't suspect IV is rich. Let's go to weekly. Do they have an implied? I don't have it saved on this. Darn. Okay. Apply volatility, add selected. Historical volatility, add selected. Apply, done. There's a little bit of a spread between implied and historical. Historical is mean flat, implied's come up. Yeah. Yeah, I probably look to sell some options, maybe some directional plays on this. Volatility doesn't seem to change too much on Walmart because it's not actively day traded. And other than these few spikes here and there, generally you don't see, other than a few spikes here and there, generally implied stays contained. So I don't think there's much of a vol play there. There's some, but not gangster amounts. So yeah, I like this one. I think it's a good idea. It's a good idea. I'd agree with this sentiment. Who's got the first call out? JN052159. Short F 2 weeks. Short is F. Ooh, come down a lot. Okay. Ford is a heavy option traded stock. 4.2 prior to today, 4.2 million, 4.25 million calls and about 3 million puts, call dominated, and over 30%, over 1/3 are coming off this Friday. That's huge. So is that 7.25 million options? 7250 if you think in thousands. Times 0.33. Yeah, so we got about 2.3 million options coming off this Friday. That's material. That's a material amount. So Ford will probably start to lose more and more support. Other than a new catalyst, they'll start to lose more and more support. How many options traded on the day? 544,000 options on 7 million. Okay, not that much. Less than 10%. Not that much. So not heavily traded on the day. Yeah, I'd be bearish on this. I would sell this on pullbacks. Probably into 18, maybe 19. Yeah, I like this trade idea. Okay, I got enough time for 2 more, and then my bladder is about to explode because I've had this one and this one. Yeah, I'm running out of bladder space. Okay, who's the next on the Zoom? E. Davis said 4 bullish long. He didn't give me a time frame, but I've just covered Ford analysis on this. So for the next few weeks, I'd be bearish on this. Let's go to the next one in Zoom. Coinbase. So Caitlin, the way it works out, or Catalin, symbol, time frame, 1 sentence description, bullish or bearish. I'm going to move on to the next YouTube one here. CGC. Wow, we're going into the cannabis space, which has kind of been a dog lately. Oof. This is probably not going to be that good. I'm guessing. Yeah, it's a pretty low option stock. It's on the low end. 200,000 calls, 80,000 puts. March 11 call bullish. So of the 290,000 options, again, about 210,000 calls, 80,000 puts, 2/3 of those options are expiring this Friday. That is material. I wouldn't be buying the calls. If you're going to get long calls, I would wait till after the expiry. You have how many? 290? 290 times 0.66. Yeah, you got 190,000 options coming off this Friday. And if there's more calls than puts, you're going to see a lot of support come out of this. I am not crazy about this. I would say if you are going to get long calls, I would wait till after the expiry. So this way you don't eat Tuesday, Wednesday, Thursday, Friday. And remember, when you hold an option over a weekend, Saturday, Sunday theta, you're taking Friday, Saturday, and Sunday theta. So instead of wasting all that theta, I would wait till after the expiry, let it settle a bit, and then maybe consider some calls. But I'm not crazy about it. Positioning suggests that it will struggle to get past 10. It will struggle to get past, 97510. So yeah, I would wait on this. If you're going to do that, I would wait until after. Caitlin never came back. She never came back with her answer. Or did she? No, she didn't. All right, Caitlin, I'll give you a few more minutes. Or Catalin, I forget if I'm saying your wrong name. Catalin Heggie, if you come back with a Coinbase, that will be great. Okay, I'll take one more, and then I'll take some open Q&A because my bladder is just it's coming for me. It's like demanding. demanding relief. Peloton bearish till this Friday, most likely. Let's take a look at Peloton. Do I have Peloton data up? No, I do not. There is some dark pool interest in Peloton, but we're talking almost dead even calls and puts. 584,000 calls and about 583,000 puts. And half of those options are coming off this Friday. Wow. Yeah, this is to be expected. More puts are coming into the market. How many of these are short dated? Not much. So most of the volume flows today were not short dated. They're looking beyond. Yeah. Yeah. Okay. All right. All right. So with that being said, Peloton bearish till this Friday. Yeah, unless Peloton gets like somebody to officially come out and say we're buying it. Remember, those are rumors and nobody came out and even addressed it. Like nobody, like Nike, Amazon, Apple, nobody came out and even said, oh, we're looking at this or we're not looking at nothing. That's not common. You know, usually there's some sort of response. They had no response, which leads me to believe none of them are interested in this. Also, some of my sources of information have suggested that Peloton is continuing to lay off a lot of employees. So that's not a good sign. That's not a good sign. We're seeing also volume has declined massively from here's the 250 million. They could do like 130 million, then like 100 million, and then like sub 50 million. Like nobody's buying this. Outside of a new catalyst, I would not want to outside of a new catalyst or announcement that they're getting acquired, I would be bearish on it. Yeah, but I would wait for a little bit of a pullback to sell Peloton. You know, if you can get up to 35, 30, almost 36, then I think you got some really good prices on that. Yeah. Yeah. Amazon said they don't comment on speculation or rumors. Yeah. Yeah. Okay, Chris, good name, by the way. Doubly good name, by the way. I know it's a complicated phenomenon, but can you briefly explain how a lot of expiring calls and inflict will shut the share price? Yeah, it's very straightforward. So if you think about it, the calls and puts can often be a material part of the price of the stock. If there are more calls than puts, then those calls have been supporting the price to some degree, right? Like if the market's going down a little bit and the traders are buying calls, well, some of that is supporting the market to some degree. If there weren't the calls, the stock would fall even faster. If the stock is going up and there's a lot more calls than puts, then they're one of the drivers of the price. If you pull that out of the market, meaning they expire, then you're pulling that support out of the market, right? So huge amounts of options coming off the board on an expiry tend to create volatility on that expiry or leading up to that, and even the day after. On top of it, those options are coming to the expiry date. So if traders are in profit on those options, they are incentivized to close them before you get to expiry because they keep eating theta decay every day they get closer to expiry. So if you have an option that is worth a little more than you paid for it, and you're like, if I hold it overnight, I'm going to lose money on this, and it's taking a big chunk out. Like if you have an option you bought for $1.50 and it's now worth $3.50, and it's 5 minutes before the close, and you're like, wow, I'm going to eat 70 cents in theta decay just by holding this overnight. Well, all else being equal, if the price stays the same, and you have this option that you bought for $1.50 and it's now $3.50, by holding it overnight, you're losing 70 cents in value. You're losing 70 cents in premium. So you are incentivized to make a decision and close that generally. And so the faster they close out, the more volatility that creates in the market. As you get closer and closer to the expiry, more and more options roll out of the market. So it changes the board massively. If you think about, you should always assume the perspective when trading options. One of the best perspectives you could ever maintain in trading options is the perspective of, what if I owned all the options on this stock? Well, that would change your perspective massively. If you owned all 700,000 options or however many there were calls and puts, that would change your perspective on how you relate to that. So that is the perspective you have to take as an option trader. They don't talk about this in books, but this is what more experienced professionals do. They take the perspective of, I own all the options. How do I need to relate to this? I have these many calls that are, losing a lot of theta decay. I have these puts that are doing good or whatever, something like that. That tells you what is the most likely scenario with that and how you should trade it. So hopefully I answer your question. Okay. All right. I'm no more call outs for the day. Let's take a few more, two more questions here. I'm glad that helped, Chris. You're welcome. Do they like to sell the expirations early, like prior to Friday, and maybe sell on Wednesday this week so theta is saved? So if you are selling, I think what you're saying is, do they want to sell the options early prior to Friday, maybe sell on Wednesday? Yes, because theta decay starts to get more and more impactful the closer you get to Friday. So yes, super, super important. Yes. Yeah. I'm not doing any more call outs, everybody. So yeah, we've covered all the call outs for today. So, all right. So anything else? Edward's saying, I need a teacher to teach me step by step how to correctly trade options. So we have an entire course that's built around that. All of these lessons are designed to give you skills in particular orders and have you go through steps to do that. So if you want to, you can join this and you can get 3 hours of live instruction from me Monday through Thursday. And then on Fridays, you can come for open Q&A, ask all your questions on any one of the days, and I answer all the questions. If you have trade ideas, I analyze the trade ideas. If you have questions how to do this, I analyze it. So we do this every single day, Edward. So I hope that you can become a Benzinga options member, because then you can get that trading. Oswaldo Veda says, do market makers manipulate the stock so options expire worthless? No, that's not their business. Think about it like this, Oswaldo. If you have the opportunity to make money in the markets, regardless of whether the market goes up or down, and you can collect millions of fees every single day just for making markets, and you don't care, market goes up, market goes down, you don't care, you still make that money. Would you take that opportunity? Absolutely. I would do it. If I had the capacity to do that, would I do that? Absolutely. I have to make decisions on whether the market is going up or down, and I have to be right. And if I'm wrong, I lose money. Like, this is my daily life. Dealers and market makers, they don't have to worry about that. They have algorithms that automatically have their positions. It's all reflexive. It's all done algorithmically, like within fractions of a second. They fill the position, they hedge the position automatically, they're good to go. And they get to make all that money without caring whether the market goes up or down. As long as their book is hedged, they've neutralized their risk, they got a great business model. They're not manipulating the market to get options to expire worthless, because that's not their model. Their model is to collect spreads. They don't care whether options expire worthless or not. As long as their book is hedged, they don't care. They want to collect those fees all day. If I had that choice, I'd do it. Think about it like this. If you were a sports bettor and somebody handed you an opportunity and says, you know what, I'm going to give you a situation where you can just bring buyers and sellers of sports bets together and have no risk in the markets. All you got to do is just fulfill orders and find buyers and sellers. Would you take that? Absolutely. Why would you want to have directional exposure if you can make money without that? We don't have that luxury. So we have to participate in the market and be right to make money. And when we're wrong, we don't. If you had the chance to make money without being right or wrong and it didn't matter, you wouldn't care. So yeah. Chris says, currently I am a pro member, Benzinga pro member. I can upgrade to the annual options membership. Is that the same as option school? Yes, you can. Talk to Rodrigo directly. Oh, wait. It's a different Chris. Please call right. Yeah. So Chris, talk to Rodrigo directly. Contact him via phone or the email, and he can help you get set up. Yes. There was one other question in here. This was a good question. So I didn't, Andy Story asked this a while back. I'm confused by the pricing of the option trader school. If you sign up with Chris, it's cheaper than if you sign up with Nick. Nick has a totally different program. He doesn't have a school. He has his program. It's not even a school. It's a different program. I am the lead instructor of the Benzinga Option School. So when you sign up for this, you're signing up for the Benzinga Option School. You're not signing up for anything else. You do get Benzinga Pro for your subscription. You get access to the school, the live lessons, everything like that. Everything's recorded. So if you miss the lesson, you can or access all those videos. But yes, totally different situation there, Andy. Oswaldo, you are welcome, good sir. How do you manage theta decay? That depends upon your position. So you have to estimate, okay, if I'm going to eat this theta by holding it overnight, what is the potential profit I can get by holding this for one more day? If the potential profit on that, and you have a high degree of confidence and skill in predicting accurately that you can make more money by holding it one more day, then you keep it open. But if not, then you close the position. So yeah. Isaac Araujo, you have to talk to Rodrigo about that. Yeah. Okay. I'm going to call it a sesh, everybody. It's been about 2 hours minus 7 minutes, and my bladder is becoming a cheerleader and really requesting me to relieve itself. So just a recap on some of the things we talked about today. Options order flows are some of the most dominant flows in the market right now. And order flow is the most proximate driver of price action. Because options are dictating a lot of the flows massively, if you don't understand options, then you're missing that 800-pound gorilla in the room that's moving the market. And if you're someone who's trading directionally or trading the markets, you need to know what's moving the market. You need to know what the weather is. What's the market gamma? What's the positioning? All these things. We teach you these skills. On top of it, it's not listed on the Benzinga Option School page, but Monday through Thursday, I provide free market commentary before the market even opens. So I let all my members know, hey, this is what you should expect in the markets today. I share trade ideas when new trade ideas come up, and I analyze all my students' trade ideas. They post their trade ideas. We analyze them every single day. And that's all done inside the classes. We do the classes, then Q&A and all that. And that's something you get access to. It literally comes out to about $2 per hour. That kind of instruction does not exist anywhere else. And so I hope, like what we talked about today is just a small piece of everything we teach in the Benzinga Option School. And I hope that if this piqued your interest, that it starts opening your eyes to see the market differently. Because once you take this class and really digest the material, you will never see the market the same. You will see it completely differently. And you get to join a great community of traders of all different skill levels, helping each other out. It's just a great community. It's very positive. They're supportive. They're going through some of the challenges you are. They're learning at a similar pace you are. And it's just a great, great community. So I hope you can be a part of that. And I hope you get to work with me on a regular basis. So with that being said, I hope you guys have enjoyed this session here today. I hope you learned something from it. And I hope to see you in the Benzinga Option School very soon. So Rodrigo, thank you for hosting this. I appreciate it. Always good working with you. And I will let you take it over from here, my friend.
Yeah, absolutely, man. Great session, Chris. Appreciate all you do here for the retail folks. I know that the students here are showing a lot of love in the chat for you. So yeah, I'll see you at the school tomorrow, right? Monday to Friday. That's where we're at, right?
Sounds good. I'll see you then, amigo. Take care.
Yeah. All right, man. I'm going to stay here for a couple of minutes, guys. If anybody has some questions, feel free to put them in the chat. Any questions you have about the Benzinga Option School, the enrollment, the period, all that stuff. Chris went over the syllabus, so I think you guys Red. Yeah, reach out, Red. You can call me tomorrow if that works for you. All right, so I'm gonna post a link, guys. Any questions, just put them in the chat. I'll leave the stream running. If you do need to find some time, get your things together, but feel free to reach out. I'm putting the contact information in the chat for you guys. So thanks for being here, folks. Any questions? The contact is in the chat. All right, guys. So thanks for being here. Appreciate you coming out with the energy here. Great session here from Chris Capre. the deal expires at midnight. So, try to do it before so that you can get everything, the Benzinga Pro, the lessons, the chat room, the full tuition for the year, including Benzinga Pro and everything else you get there. So yeah, good stuff, guys. Thanks for being here, and we'll see you guys next time.